Welcome and good morning. My name is Sylvia Martini, and I am your interim CEO at the Greater Saskatoon Chamber of Commerce. As we gather here today, we acknowledge we are on Treaty 6 territory and the homeland of the Métis. We pay our respect to the First Nations and Métis ancestors of this place and reaffirm our relationship with one another. We are delighted you are joining us for another Saskatoon Chamber popular presentation within our series, Bridge to Business, wherein we explore valued areas for consideration toward a strong and vibrant community from and through our business sector. Celebrating 113 years as the official Board of Trade for the City of Saskatoon, our Chamber work has never been more important than now through the encompassing challenges of COVID-19 pandemic. We are reminded of this daily through our members' voices and expressed anguish and concerns, but also we are empowered by their courage and resilience. Your Chamber works passionately on our mission to build and promote a strong community through prosperity in business. This we do more so than ever within our guiding principles of integrity, courage, inclusivity and diversity, open communication and transparency, and pursuit of knowledge. Our event today is generously supported by our event partner and sponsors. We extend our sincerest gratitude to our event partner, KPMG, our event sponsors, PAR Autobody, Saskatchewan Rush, and our Government of Saskatchewan Ministry of Trade and Export Development. Thank you. This event would not have been possible without your generous support. Joining me today as your moderator for this event is Colton Wiegers. Colton is the COO of Wiegers Financial and serves our membership in his second term on the Chamber Board of Directors.
Hello, everybody. I believe we're having we'll have Sylvia back in a moment, but as she was mentioning, my name is Colton Wiegers. I'm the COO of Wiegers Financial and Benefits and serving my second term on the Chamber Board of Directors, and I'm the chair of the Advocacy Committee. So we encourage our audience members to use the question box to the right of the video screen to ask your questions, which will be moderated by me. Joining us today and welcoming you to our event include Chamber Board members, Board Chair Carla Brown, Past Chair and Director Chris Seacott, Todd Denson, Joseph Gill, Juan Godinez, Sandra Ribeiro, and Tanis Taylor. A special note of welcome is also to Joshua Kirchian, Director of Research and Policy Development of our Saskatchewan Chamber of Commerce. Welcome to all. Please do note that this session is being recorded and will be available in the near future through bankofcanada.ca and our chamber website link at saskatoonchamber.ca. Notification will be issued on our social media channels and blog. It is now my distinct pleasure to welcome our very special guest speaker today to explore what economic growth and urbanization means for Canadian cities and the housing market. Deputy Governor of the Bank of Canada, Lawrence Schembri became Deputy Governor of the Bank of Canada in 2013. In his role, he oversees the bank's analysis of domestic economic developments and shares responsibility for setting monetary policy in Canada. Mr. Schembri first came to the bank in 1997 as a visiting research advisor on a sabbatical from his post as an associate professor of economics at the Carleton University. He joined the bank permanently in 2001 and became chief of the International Economic Analysis Department 4 years later. In 2010, Mr. Schembri was named advisor to the governor, a position he held until his current appointment. Mr. Schembri holds a Bachelor of Commerce degree from the University of Toronto, a Master's in Economics from the London School of Economics and Political Science, and a PhD in Economics from the Massachusetts Institute of Technology. His published research has focused on exchange rates and monetary policy in open economies, the international monetary system, and financial stability. Mr. Schembri, a warm welcome to our forum today and virtually to Saskatoon.
Thank you, Colton, for the very kind introduction, and thank you to the Chamber for the thoughtful invitation for me to speak to you today. Good morning, everyone. I hope you are all well in Saskatoon. I very much regret that I can't be there in person with you. The COVID-19 crisis is disrupting all of our lives, and unfortunately some more seriously than others. And because of the pandemic, we are all living with limits on our behavior. One of the things I enjoy most about giving public speeches as a deputy governor is having the opportunity to visit towns and cities throughout Canada, and especially to meet people like yourselves. I very much like listening and learning about your businesses and the local economy, and discussing the Bank of Canada, our economic outlook, and our policies. We are fortunate to be living in a time when technology can make some of this experience possible, even under the current circumstances. Collecting your views will be most helpful today because I want to talk about the impact of the virus and the related containment measures, what we know as physical distancing, on the day-to-day behavior of Canadian households. Je voudrais surtout parler des changements dans les dépenses et biens et services et dans l'achat de logement. J'aimerais aussi parler de l'évolution de l'emprunt des ménages et leur endettement. To repeat that in English, I would especially like to examine how spending patterns have changed for goods and services and for housing. I'd also like to discuss shifts we are seeing in household borrowing behavior and indebtedness. Analyzing the behavior of Canadian households during the containment period and in the early stage of the reopening will give us insights into how the economy might perform going forward. In particular, we are interested in the speed, strength, and breadth of the pickup in economic activity during the recovery period. Consumption and housing will be critical to the recovery as they normally represent roughly 2/3 of economic activity in Canada. Household behavior since the outbreak of the virus in mid-March has been shaped by both changes to demand and supply. On the supply side, the restriction on the goods and services available for sale have changed what we are buying. On the demand side, the economic lockdown has had a major impact on household income and confidence. Fortunately, before the pandemic struck, the Canadian economy was in reasonably good shape. Inflation was close to our 2% target, and wage growth was solid, consistent with an economy operating close to capacity and an unemployment rate near a 40-year low. This resilient starting point allowed Canadian authorities to respond with an extraordinary set of aggressive, remedial, fiscal, and central bank policies, mitigating the negative impact of these forces on household behavior. Fiscal policies have helped replace lost income, while the bank's policies focused on reducing financial system stress have maintained low-cost access to credit. These policies have bridged households to the recovery period. Given this context, I'd like to use this speech to explore three main points, simply illustrated by my first chart. First, household expenditure on goods and services, as well as on housing, changed dramatically during the containment period, as shown in the diagram from point A to B. The level of spending fell and its composition shifted. While most of this change in behavior is likely to be temporary, some of it could persist. Second, we are seeing signs of a partial bounce back in household spending in the first phase of the recovery. This reopening from B to C happens as the Canadian measures are relaxed. Households are now able to buy goods and services that were not easily available during the containment period. And as you can see, I definitely need a haircut. So that's one of the things that wasn't available to me earlier. We are also seeing an increase in employment income and household confidence as workers are rehired and economic activity picks up to satisfy this rebound in demand. Finally, we expect the second phase of the recovery, from C to D, will be a more gradual phase of recuperation. because the future evolution of the virus and the economy remains highly uncertain. As well, the recuperation phase could be bumpy as different provinces and sectors open up at different times. It could also be slowed by an economy scarred by widespread firm closures and by displaced workers who may have to relocate or retrain to find employment. As I discuss the road ahead for households, I will also examine the Bank of Canada's policy actions to support the recovery, have complemented the measures taken by the government that have targeted vulnerable workers and households. Before I discuss how spending has changed, let's examine two key determinants: income and confidence. The pandemic and the resulting economic shutdown, as well as the related decline in global oil and other commodity prices, have had an unprecedented adverse impact on household income. Let's now consider the sharp fall in employment and economic activity in Canada. Since February, nearly 3 million jobs have been lost, and the average employee is working 4 fewer hours a week. This chart shows that the industries most affected by physical distancing measures, namely accommodation and food services, construction, and transport, have experienced the greatest losses in total hours worked. Overall, this has resulted in a 25% decline in total hours worked in Canada since February, a huge shock. The unemployment rate in May 2020 was worse than that experienced during the global financial crisis. It increased to 13.7% and would have been even higher, had 1.2 million Canadians not left the labor force. What's more, job losses were more pronounced among lower wage workers who typically have less savings and less access to credit. The level of labor income is estimated to have dropped by about 15%, or more than $40 billion in the first half of 2020 relative to the pre-COVID-19 level. These effects on total employment income were largely offset by the swift policy actions of the federal government, notably the Canadian Emergency Response Benefit and the Canada Emergency Wage Subsidy. These benefits were well targeted as the income replacement rates were the highest for the most vulnerable workers. Consumer confidence has also plummeted because of the immense impact of the virus and the related control measures on employment and increased uncertainty about economic prospects. The decrease in incomes, in consumer confidence, in the willingness of shoppers to leave their homes all led to much weaker household spending. To see this impact, let's take a closer look at what happened to retail sales in April of this year. The thin red line in the middle represents retail trade for all of Canada, while the lower purple line is the energy-producing regions of Alberta, Saskatchewan, and Newfoundland. And the light blue line on top is the rest of Canada. Clearly, as you can see in the chart, all have fallen dramatically. Let's now consider how consumption patterns have shifted. The early stages of the shutdown saw a boom in demand for necessities. Many households stocked up on food, alcohol, and personal care products. The infamous runs on toilet paper, flour, and cleaning products. This chart shows that in the first week of March, sales of hand sanitizer, the light blue line, rose 792% over the same week last year. Toilet paper, the red line, soap, and masks and gloves also saw a marked increase. But demand elsewhere was slumping, as larger ticket items like cars and necessities such as clothing and shoes became more difficult to buy. Spending on outside the home entertainment, restaurant meals, travel and personal services effectively came to a halt. Now let's consider how these shifts in spending patterns have affected consumer prices. There has been a sharp deceleration in consumer price index over the last 3 months, from February to May, from 2.2% to minus 0.4%. These two charts provide an interesting comparison. On the left, we see CPI components whose prices have declined, including gasoline in blue, travel accommodation in green, and clothing and footwear in red, as the demand for these items has decreased. In contrast, the chart on the right shows upward price pressure on consumer goods such as paper products in blue, food in stores in red, and household cleaning products in green, largely reflecting stronger demand. The pandemic also had a pronounced effect on the housing market. The market effectively stalled during this period. Let's take a closer look. As with consumption, there were both supply and demand forces that drove the drop in spending on housing. On the supply side, activities related to buying and selling a house became much more difficult to do because of the physical distancing measures. On the demand side, the decline in employment, income, and wealth, as well as increased uncertainty about the future, hurt confidence. This chart illustrates the impact of these forces. The red line, resales, and the blue line, new listings, both dropped sharply in April. However, the declines were concentrated in provinces that were quick to impose more stringent measures. These include Quebec, Ontario, and British Columbia. I'd like to turn now to the impact of the pandemic on household borrowing and debt. This chart shows that since the COVID-19 crisis began, total household credit growth, represented by the black line in the middle, has decreased. This has occurred for two main reasons. First, as I mentioned earlier, various policy measures are helping indebted households cope with income losses and lowering the cost of servicing some existing debt. In addition, Canadian banks have allowed more than 700,000 households to delay mortgage payments up to 6 months. Second, shifts in household spending have also played an important role in limiting the need for additional borrowing. This fall in credit demand is especially true for purchases such as cars. In April, consumer credit, which includes car loans, plunged by about 15% on a 3-month annualized basis, marking one of its biggest drops on record. We can see the dramatic decline in consumer credit represented by the red line in the chart, while real estate secured lending, the light blue line, rose, reflecting activity earlier in the year. Despite this easing in household credit growth, the vulnerability associated with highly indebted households we have identified in our financial system review remains. In the May FSR, we highlighted that some of these vulnerable households will likely fall behind on their loan payments if incomes do not recover by the time the loan payment deferrals end. Let's examine the issue of household insolvencies in more detail. This chart illustrates the deviation of the insolvency rate from historical averages in energy-producing provinces and the rest of Canada. Saskatchewan is represented by the light blue line, while Alberta is the red line and Newfoundland is green. Although insolvency rates are relatively low, they have risen in these provinces relative to the rest of Canada, which is the yellow line, reflecting the impact of lower oil prices in recent years. Let's now turn to the future as the containment measures are being relaxed and economic activity is picking up. I'd like to turn back to the chart I used earlier and elaborate on the expected two-phase recovery in economic activity and household spending. The first phase, the reopening, consists of a relatively rapid and strong pickup as some of the containment measures are lifted and households resume consuming goods and services they could not easily buy during the containment period. We're already seeing this in the data for car sales and sales of existing houses, supported by recent increases in employment and consumer confidence. But this recovery will only be partial. The second phase, the recuperation is highly uncertain and thus will be more prolonged and uneven. The willingness of households to spend will depend on many factors, including the recovery in employment, income and confidence, and the possibility of future outbreaks. While the drop in employment has been severe, there are some positive signs. The hardest hit sectors, such as restaurants and retail, typically have a high degree of employee turnover as they employ more mobile workers. That may make it easier for firms to rehire when operations resume. Also, it is important to recognize that a sizable share of the decline in total employment was from temporary layoffs. This chart shows permanent and temporary layoffs for various age groups. The blue bar is permanent, while the green is temporary. The top bar shows all workers, then followed by prime age workers, and the bottom bar, top bar shows all workers, then youth, followed by prime age workers, and the bottom bar is seniors. Overall, temporary layoffs are just below half of the separations. This suggests more attachment to former employers so that the recovery could be fairly strong. But permanent layoffs are much higher for young workers, and more persistent disruptions in the job market could slow the recovery. There have also been permanent layoffs among lower income workers in energy producing regions where economic activity was already struggling to regain momentum. De plus, les secteurs de services où la distanciation physique est difficile ont été durement touchés. Cela affecte beaucoup plus les femmes qui doivent faire face à un manque de services de garde. Les fermetures permanentes des entreprises, ainsi que la faible reprise mondiale, vont aussi freiner la croissance de l'emploi, des revenus et des dépenses des ménages. The housing market may also face headwinds beyond the early lift in activity we've started to see. For example, immigration was playing a key role in boosting demand prior to the pandemic. This source of demand could take some time to be restored as authorities clear backlogs and travel restrictions around the world are eventually eased. The recovery in services, which are subject to more delayed removal of containment measures, such as travel services, is expected to be more protracted. The same is true for services that are usually consumed in crowded environments, such as cultural and sporting events, including Saskatchewan Roughrider football games. We also expect that recovery will vary by region because confinement measures are being lifted at different times across Canada. This staggered reopening of establishments and manufacturing facilities across the country adds an additional layer of uncertainty in estimating the path of the recovery in household spending. Looking ahead, the pandemic may also accelerate some of the structural changes in spending that were already underway. For example, the increasing trend towards online shopping and food delivery has made the economy more resilient through the downturn and could help support the recovery once it is underway. In summary, there are various often opposing forces that will influence the pace, strength, and breadth of the eventual recovery in household spending from this unprecedented downturn. Consequently, the uncertainty around this recuperation phase is extraordinary and points towards a recovery that will be gradual and long-lasting as this uncertainty slowly dissipates and household confidence is restored. Households are likely to remain cautious in their spending behavior as they adjust to new post-pandemic normal. Let me now conclude. The COVID-19 pandemic has had unprecedented and very serious effects on the Canadian economy and on Canadian households, and the aftershocks will likely continue for some time. The recent data indicate that a recovery has begun and that a more severe outcome has been averted, thanks to an extraordinary set of policy actions taken by the federal and provincial governments and the Bank of Canada. Still, the path ahead for households is likely to be protracted and uneven. The lifting of restrictions on economic activity will be measured and incremental and differ across provinces and sectors. Cautious spending behavior on the part of households will likely persist as uncertainty about the virus continues, including concerns about future outbreaks, until a vaccine becomes available. Consequently, employment and income will likely take some time to recover fully. La Banque de Canada est prête à prendre les mesures nécessaires pour soutenir le système financier et pour favoriser la reprise et atteindre sa cible d'inflation de 2% dans un laps de temps raisonnable. Soulignons que ces interventions viennent compléter les mesures prises par le gouvernement. As I've just said in French, the Bank of Canada is prepared to take the necessary actions to support the financial system and to underpin the recovery to achieve our 2% inflation target within a reasonable time frame. Importantly, our policy actions will complement those taken by the government. Fiscal policy is better able to target the needs of vulnerable households and specific sectors and regions of the country, and can be scaled to provide sufficient support. Together, our determined efforts will help our economy overcome the effects of the pandemic and achieve strong and sustainable employment and output growth for the benefit of all Canadians. Thank you for your attention. Merci beaucoup. Je suis prêt de répondre à vos questions. Thank you.
Thank you, Mr. Schembri, for sharing all of your insights, both from yourself and from the Bank of Canada. I know our membership has a lot of questions they've already been sending in, so I'll jump right into it. Our first one from our membership. We hear a lot about the potential for a second wave of the pandemic, perhaps in the fall. Depending on the severity of the wave, what would be the effect on a second wave on the economy?
If a second wave was relatively severe as the first wave was, that it entailed a fairly broad-based economic lockdown like we saw starting in mid-March to what we are now, I think that could be another very serious impact on the Canadian economy. So that's something that we really have to avoid, because employment and spending dropped seriously during the containment period recently, and we need to avoid that happening again. So I think the measures taken to control the virus have to be very cautious and prudent to avoid that second wave.
Thank you. And as it relates to measures and trends going forward, what can we expect to see going forward with saving versus borrowing or debt capacity? Are people likely to be more reluctant to invest based on the recent downward fluctuation in the market?
Well, we've seen a fairly sizable increase in savings from the fourth quarter of last year to the first quarter of this year. Savings went up from 3.6% to 6.1%. As I mentioned in my presentation, a lot of this reflects the fact that consumers were not able to buy the usual set of goods and services they normally buy, so that often the money just simply accumulated in the personal bank accounts. Also, some households were precautionary, knowing that perhaps their employment was at risk, and so they saved more as well. So I see the savings remaining relatively high until some of this uncertainty about the future is resolved and household confidence is stronger. Depending on how quickly we were able to control the virus, that confidence would improve, and perhaps savings would move back down to the levels we saw in 2019. In terms of investment, well, I think that some people may decide to invest some of their additional savings, and some may decide to purchase items that were postponed. For example, buy a bigger house or buy a new car. So it depends really on the individual household.
That makes sense. And you did touch on that a bit in your presentation, the stalling of purchases, and especially the larger ones. And on the topic of changing habits, we have a question that says, consumers have become more adept at online shopping, which again, you had mentioned, or the curbside pickup style of consumerism. How permanent do you think these changes to shopping habits are?
Well, we've noticed over time that Canadians have been making greater use of online purchases. And so that trend was already sort of in the data. And I think the experience of the containment period was that this trend was accelerated. So we expect that to continue. I think more people got involved in purchasing online, and I think they came to realize it's not as difficult as they might have imagined, so they're likely to stay with it. With respect to curbside purchases, my sense is that most Canadians, if they're visiting a store, would probably like to go inside and see the purchase. So I see that type of behavior probably becoming less prevalent in the future.
That makes sense. And I like your point there too about, these trends were already coming, but they're just pushed ahead, 1 or 2 or 3 or 5 years perhaps. And another one of those trends that's been pushed ahead, and a question relating to that is, many people have shifted to remote working during the pandemic, and productivity in many cases, productivity has remained high. Do you think that we will see less businesses looking to utilize traditional office spaces? And what are the anticipated effects of this on the commercial real estate market?
Well, I think that trend has also been in place for a while, and again, the experience of the pandemic where people can see that they can remain relatively productive by working at home. At the same time, I think there's a recognition that humans are a social animal, that there's some advantages to being in close contact with your colleagues because it permits a rapid exchange of ideas. And so I think there is going to be this trade-off, but you speak to the younger generation like my daughters, and they feel completely comfortable collaborating with their colleagues online. I mean, I much prefer, and that maybe reflects my age, much prefer the face-to-face contact, but it remains to be seen. I think that for the younger generation, they seem more comfortable working online, and perhaps that trend will continue, but I still think there's some value in the face-to-face interaction.
Absolutely, and I'm a very social person, I find too, but I've warmed up quite a bit to the remote working, so I'm curious how many other people working will like to try to keep this as a trend going forward. Our next question pivots a bit from there. How does the Bank of Canada see the global investment climate changing for and within Canada, both in the short and in the long run?
So that's, let me try to parse that question. So are you looking at in terms of investment, in terms of foreigners investing in Saskatchewan, or people in Saskatchewan investing abroad, or I just want to be clear to how to interpret that question, because I can easily interpret it as foreign investment coming into Saskatchewan if you wish.
Let's go with that, and I'm reading some from our membership. So for the member who asked that question, if we don't answer it exactly as you were looking, please submit another variation of it too.
Well, I mean, Canada has had a long history of foreign investment playing a large role in our economy, and particularly in the resource sector. And I think that reflects that we have a strong comparative advantage in resources that other investors want to invest in. And it also reflects the fact that we have other advantages as well. We have a highly trained workforce. We have a rule of law that respects property rights, enforces contract laws. So I think people can invest in Canada with a great deal of safety. And so I think that that's still going to hold true. And I know Saskatchewan has also benefited specifically from foreign investment in some of their sectors. So I expect that will continue. I mean, one of the issues that has come up during the pandemic is there's been some fragmentation of the global economy. But I expect that Canada will still remain an attractive place for investment, and especially Saskatchewan.
That makes sense. And you bring up a lot of good reasons of why Canada has been and will continue to be a great investment location for people. Our next question here. Are you more concerned with low inflation and potentially deflation given the depth of the economic downturn? Can you elaborate on the concerns around deflation and how the bank might respond?
Well, as you know, our target is 2% inflation. And by achieving 2% inflation like we've done over the last 30 years, that means it gives a very well-functioning anchor, nominal anchor to the Canadian economy that Canadians can actually use in making decisions about setting wages, setting prices. And so the concern we have is that if inflation goes below 2% for a persistent period of time, that those expectations will become unanchored. And that really creates problems for the functioning of the economy, but it also creates problems for the effectiveness of monetary policy. Now, specifically with deflation, if inflation was to become negative and people were to expect that going forward, that has a lot of deleterious effects because people's incentives are actually to put off consumption because they know the prices of things they're going to buy are actually going to decline, and that actually makes things worse. And on the debt side, the real value of people's debt goes up, so the burden of the debt increases, which again suppresses their demand. So deflation, persistent deflation, is a serious concern because once it becomes part of people's expectation, it can actually make the situation that much worse. So that's clearly a situation we want to avoid.
That makes sense. And I do know a lot of folks are asking with the spending going on between the United States and here and other countries if that will be a real concern going forward. So thank you for that response. So another question that we have a membership that's very eager to get your opinion on a number of things. You suggested that COVID-19 has acted as a catalyst for accelerating already ongoing structural changes to the economy, digital and tangible activities, remote work. What are the taxation implications for the federal government going forward?
Well, I mean, to the extent that, that's a sort of question outside our remit because we're not really the fiscal authority, but I'll try to provide a brief explanation. I think that those activities, revenue is being generated, normal taxation rules in terms of provincial and GST taxes would apply, income taxes would apply. So I think that this transformation really would not have a huge effect on taxation policy. I mean, there may be some need to adjust it, but I don't pretend to be a taxation expert. But I think the authorities down the street at the Department of Finance have given this a lot of thought, and I think they'll be up to the task of finding ways to ensure that that the effect of these shifts in the economy will not affect taxation, the fairness of the taxation system across Canada.
That makes sense. And a bit of a loaded question for you, of course, too. Yeah. So understandable. It's a big, broad topic for sure. I'm looking at our queue for questions here, and I believe I have the last question before we'll get wrapped up. And again, thank you for your time today. So our last question is, 2019 GDP data shows that Saskatchewan was in a mild recession even before COVID-19 and the oil price shock. What's your outlook for the Saskatchewan economy?
Well, my understanding is that the Saskatchewan economy was suffering from some weakness in other types of commodity prices, namely uranium and phosphates. So I think that's going to. My understanding is the outlook for those commodity prices is likely quite positive. So those should recover in the future, and so in that way, I think that should strengthen the Saskatchewan economy. And over the long term, I think the Saskatchewan economy has a lot of promise in the sense that it clearly has a very strong comparative advantage in producing agricultural products. And if you look at world demand for agricultural products, they've been steadily increasing over time. And I think that's going to really be a great benefit to Saskatchewan going forward. Saskatchewan's products have a reputation for being high quality, and I think that will put them in very good stead going forward as global demand for food increases.
That makes sense. In Saskatchewan, we often refer to ourselves as, one of our goals is to feed the world, and I think agriculture is a huge piece of what we do in the province, but as you mentioned too, globally too, the impact that we have there.
And you do it well. I mean, I think your exports to the rest of the world are really exemplary, and you're known for the quality of your agricultural products.
We might have one more question. I'm just finding out from our crew who's sending me them. We might sneak in one more before we go. No, I think we'll wrap up there. I think someone had a bit of a comment, but we'll wrap up there. Thank you, Mr. Schembri. We greatly appreciate your presentation today and all the questions that you've answered for our membership. Definitely valued by all of those in attendance, and also for those who could not join us today and who have the benefit of viewing the recorded session afterwards. Understanding the economic impact by sector of this pandemic from the perspective of the Bank of Canada, as well as the mitigation efforts through policy measures, has provided valuable insight, assisting our audience today to better understand the cause and effect of such significant and catastrophic events. So understanding this forecast will help us better prepare for this next period, and we thank you very much for your presentation today, and again for your comments on our local province here. From the Chamber's end, we'd like to also extend, From the Chamber's end, we'd like to extend a gratitude to the Bank of Canada for this presentation, and to our event partner KPMG and sponsors Par Auto Body, Saskatchewan Rush, and our Government of Saskatchewan Ministry of Trade and Export Development. Ladies and gentlemen, on behalf of the Chamber Board and staff, I thank you for joining us today, and please do visit our website, saskatoonchamber.com, for our event calendar, and stay tuned as we post this video afterward as well. And Mr. Schembri, I'll leave it to you if you have any other closing comments.
I just wanted to thank you and Sylvia for kindly hosting this event this afternoon. I've really enjoyed it. I'm grateful for the thoughtful questions that were posed. I think they very interesting and useful for me to explain our views on them. Okay, thank you for the opportunity. It was a pleasure.
Thank you so much, and thank you everyone for watching.